Hello everyone and welcome to this flash course in moving averages for beginners. My name is Darren Maddox and today I'll run through what moving averages are, the two main types used in technical analysis, why they act like price magnets used for stop losses and entries, and explain dual and triple moving averages. All of this leading to the next lesson where I will demonstrate how to use the percentage band rule DEMA trading strategy, which you can use straight away to start profiting. So what is a moving average? A moving average is a technical indicator that smooths out price data over a specified period to create a single flowing line on a chart. Let's add this in. We go to your indicators, type in moving average. You can add moving average exponential here or moving average simple for now to chart. Click that and this will bring up these moving averages. Now, if you go into settings, I've got a 200 moving average on here, which is a long moving average, over 200 candles back, that means. And you can change that to whatever sample size you want. And these moving averages helps identify trends by filtering out short-term noise and volatility. Essentially, it's the average price of an asset like stock, forex pair or crypto calculated over a set number of periods, and it moves as new data comes in, dropping the oldest data point and adding the newest one. Now, if price is trading below the moving average, it's generally considered to be in a downtrend. If the price is above the moving averages, it's considered to be in an uptrend. And this simple above-below rule can help you quickly gauge the market's current direction. Moving averages act like price magnets because subjectively they attract price action because they're widely watched by all market participants. Similar to Fibonacci levels, they become a self-fulfilling prophecy heavily used by traders, investors and algorithms for entries, exits and stop losses. Objectively, they are a derivative of price itself, so statistically, price will spend more time at its average than anywhere else. That's why it's the average after all. Okay, there are two main types used in technical analysis, the EMA and the SMA. The EMA, which I've added here, is the exponential moving average. And this gives more weight to recent price, making it more responsive to new information and quicker to reflect trend changes. It's calculated using a formula that emphasizes the latest data points. The simple moving average, which I have added here, again I've added 200 just so you can see the difference between the two. You can find that in moving average simple in your indicators section, and you can see how the simple moving average takes a bit longer each time to react to the trend change. So obviously my preferred is the exponential moving average, while other people do prefer the SMA. And the SMA is just an arithmetic mean of prices over the period with equal weight to all data points. Now longer EMAs, like the 200 I've shown you here, or the 50 or the 100, are used to identify the larger ongoing trend, as well as potential support and resistance levels. Let's just pick one here. Let's hide the SMA for now. We can see how it acts as support, breakthrough, new downtrend, resistance, price rides the band, resistance, price closes above, and now it starts to become support. The EMA flicks upward, telling you you're entering a uptrend. This is the Euro US dollar 1 hour, by the way. Forex is pretty good for this. And you can see how price constantly comes back to the EMA. Ding, ding. That's a signal to go long on a false breakdown, test again, false breakdown. Then you get a real breakdown, resistance, etc. And I'm sure you can see just from looking at that a strategy forming in your mind. It's not to be used on its own, remember, you have to use it as part of a larger trading strategy. These long-term EMAs act like price magnets because institutions and big players often base their decisions around them, creating strong psychological barriers where price tends to consolidate or reverse. There are so many options to choose from, but my preferred option is the 200 EMA, but many will argue that 50 is better. Each EMA changes at different speeds. The lower the number, the more sensitive it is to price changes, the faster it is to react. This leads to more signals for a trader. Sounds good, right? Well, this also means more false signals, less accuracy due to whipsaw. The higher the number, the slower it adapts to price changes, but this does mean fewer signals, however more reliable. Finding a balance between them that suits your risk level and trading style is key. Some people prefer to win more, some people prefer their higher returns with less wins. So your trading style is key to choosing one of these, and you can backtest on historical data, of course. Generally, if price closes on the opposite side, it signals a potential trend change, and when confluence is used with other tools, offers entry signals and stop loss areas for swing strategies or a shift to risk on/off investments, so you will see people opening or closing positions. And they're especially useful on mean reversion trading strategies. So dual exponential moving averages is when you overlay one short and one long EMA. So we can prepare for the trading strategy in the next video. I'm going to show you what this looks like on the shorter EMAs. So we've got 5 and 12 here now. I've turned the candle brightness down so you can see these EMAs. They stick close to the candles because they're only 5 and 12 samples back in this case. When short EMA, the 5, in this case the blue one, crosses the longer EMA, the yellow one, this is used as an early signal for bullish trend change. When it crosses below the long one, this is an early signal for a bearish trend change. There is an abundance of combinations to choose from and many arguments and studies to back them up. Moving averages work on all time frames from the 1 minute to the weekly and all assets. My preferred is the 5 EMA and 12 EMA, as my dissertation tested hundreds of iterations, proving this to be the best for my specific strategy. I have linked the dissertation in the description, but we'll be going through the full strategy in the next video anyway. Let's take a quick look though, so you can see how it works. You have your bearish cross. Let's put the 5 and 12 on. Remove the 200 for now. Okay, and we'll start from back here with some quick examples. You've got the cross here, and you put you enter short. Really close, just above the moving average. These give great RR returns. And you allow your trade to follow those bands down until the opposite signal occurs, the opposite long cross. This trade would give you a 9.17. You have a fake out here, which will be avoided through the threshold theory I will explain about in the next video. This gives another short opportunity where you can enter right above that AMA cross, follow it down to the next opposite cross, which is here, and you can see that provides another 5.43. There's a bit of whipsaw here that might knock you out, but you would actually avoid this with threshold theory with potentially a very small trade here, basically knocking you out at break even in this one. And on the bullish side, things flip bullish. You take a long position until the EMA crosses again, which is your close signal, 3.64. This short here was small, you could take that as well. Another long signal. This one offers a, let's see, 7.07 until the opposite cross signal, and so on and so forth. Beware of false signals, which exist in every strategy. Price could swing below or above for a sustained period of time before recovering, continuing in the larger trend. Moving averages work best in trending markets and suffer in ranges. One person's false signal is often another person's signal. A swing below the line and recovery can be a strong trend following strategy. Now, the triple moving averages is exactly as it sounds. We just add another moving exponential average in, which is a middle speed one, EMA 9. Let's just remove these. But basically, I found this to be more noise than helpful adding a third one, but others will argue differently. You're waiting for both lines to be crossed from the shorter EMA before taking any actions, and you wait for the average one to also be on the positive side of the long EMA before taking trades. So it's pretty similar, just with an extra line. Now that we know the basics of moving averages, I'll quickly discuss some useful tools for you to look into that build upon moving averages. Consider this homework if you like. The MACD, moving average convergence divergence, plots the difference between two EMAs as a histogram and signal line. Crossovers and divergences signal buys and sells. Now, these can be found in your indicators. Type in MACD, moving average convergence divergence, and this gives you a indicator as discussed. And another one is the Bollinger Bands, which uses a simple moving average with upper and lower bands set at the standard deviations of the moving average. Indicators, Bollinger Bands, you can see it wraps the standard deviations around the price action. They expand and contract with volatility. Price touching the bands can signal overbought, oversold, or breakouts. And that's your homework, and that covers the basics of moving averages. In the next video, I will demonstrate and explain my trading strategy, the percentage band rule DEMA, or PBR for short. Thanks for watching. Don't forget to subscribe to get the latest videos and drop a comment with your favorite moving average combinations. Hit like if you enjoyed the video, and safe trading.